How the financial system actually works. Money makes the world go round. But how does it actually work? Your paycheck hits your bank, gets loaned out to businesses, flows into pension funds, hedge funds, insurance companies. It's one giant interconnected machine. Let's break it down, fast. Central banks, the puppet masters. Every country has one. The US has the Federal Reserve. They control two things, interest rates and money supply. Economy too slow? They cut rates, flood the system with cash. Borrowing gets cheap, businesses expand, people spend, too much inflation? They raise rates, suck money out, cool everything down. That's it. They're basically playing God with the economy. Commercial banks, the workhorses. JP Morgan, Bank of America, Wells Fargo. This is where your money lives. Their real job? Moving money from savers to borrowers. You deposit cash, they lend 90% of it to someone buying a house or starting a business. And here's the wild part. When they issue a loan, they're creating new money that didn't exist before. That's how the modern financial system expands. Pension funds, the silent giants. Before your paycheck even hits your bank, about 10% is already gone to a pension fund. These are the biggest financial institutions on Earth, controlling over $60 trillion worldwide. They don't just sit on that cash. They invest aggressively. Stocks, bonds, real estate, private equity, venture capital. The Ontario Pension Fund owns Hudson Yards in New York. These aren't small players. They're quietly bankrolling the entire financial world. Mutual funds, investing for regular people. Vanguard, Fidelity, BlackRock. Mutual funds pool money from thousands of everyday investors and buy giant baskets of assets. Two types, actively managed, where professionals try to beat the market, and passive funds that just copy an index like the S&P 500. Passive funds are cheaper, and honestly, they usually win. Most active managers can't consistently beat the market long term. Hedge funds, the big dog gamblers. Bridgewater, Citadel, Jane Street. Only for the ultra-rich. You need $1 million net worth just to get in. They bet on everything. Stocks going up, stocks going down, currencies, oil, crypto, elections. They use leverage, short selling, complex derivatives. Most hedge funds actually underperform the S&P 500. But the rare ones that hit, they absolutely crush it. Jim Simon's average returns triple Warren Buffett's. They charge 2% of everything you invest plus 20% of profits. Expensive, risky, and addictive. Investment banks, the deal makers. Goldman Sachs, Morgan Stanley. These are Wall Street's corporate matchmakers. Their favorite trick? Leverage. Buy a $100 million company with $20 million of their own money and $80 million in borrowed debt. Then dump that debt onto the company they just bought. If it fails, they walk away clean. If it succeeds, they make 3 to 5 times their investment. Blackstone bought Hilton Hotels for $26 billion and walked away with $14 billion pure profit. When it goes wrong, though, like Toys R Us loaded with $5 billion in debt, the company collapses, and private equity just shrugs and moves on. Venture capital, startup gamblers. Sequoia, Andreessen Horowitz. VCs throw money at hundreds of startups, knowing most will fail. The model is simple. 90 startups fail. 7 break even. 2 or 3 return 10,000 times your money. Peter Thiel invested $500,000 in Facebook in 2004. It turned into over $1 billion. One winner covers every loss. That's the game. Insurance companies, risk spreaders. State Farm, Geico, Allstate. They collect premiums from millions of people and pay out when things go wrong. The healthy subsidize the sick. The safe drivers subsidize the crash victims. But here's what most people miss. Commercial banks move it. Pension funds grow it for retirement. Mutual funds let regular people access it. Hedge funds gamble with it. Investment banks deal it. Private equity flips it. Venture capital bets it. insurance companies spread the risk of losing it.